Good day, ladies and gents, and welcome to our new multi-asset quarterly update. We are going to start producing these hopefully in the first few weeks of each quarter end, specifically on our new multi-asset funds, which we are really excited about and which we're trying to share as much information with the market as is possible. So the first quarterly update is a really interesting one, and it's really interesting because it's been absolute chaos, to say the least, in global markets. We've experienced what will probably be referred to in the future as the COVID crash. And really, it's been a total global economic meltdown where the World Health Organization declared a pandemic early on in the quarter. About midway through the quarter, COVID cases have reached 750,000. And we've seen massive global sell-offs in worldwide markets. MSCI Equi down 22% over the quarter, which is really significant sell-offs. This is down 22% in US dollars. Most global countries, in response to this crisis, have moved really quickly on their stimulus packages and some of their repurchasing of bonds and dropping of rates. The big challenge is, even though these are valiant attempts to offset some of the economic impacts of COVID, is that we're not really certain whether they will be effective, and their impact is yet to be assessed. So we would hope for the best, but it has been impressive, the kind of cohesive nature that the global central banks and politicians have stepped in to try and deal with COVID as best as possible. So that is certainly a positive story we can take out of it. In terms of where the cases started to climb and we went into full lockdown. So that will, of course, have massive impact on the South African economy and, in turn, South African assets, equities, properties, even to the extent of bonds, where we, in many respects, eventually saw Moody's downgrade SA sovereign credit rating to below investment grade. That they've been the last of the investment or of credit rating houses to hold back on the credit drop, and they eventually did so in the face of a lot of economic pressure coming from the lockdown and the COVID crisis, along with all the structural issues that South Africa is well known to face at current state. All of this having a massive impact. The USD ZAR exchange rate exceeded 1870 in the quarter. Remember, having starting the year at about 1477, so massive weakness, 26% weakness in the rand. This not all due to South African specific risk, of course. A lot of emerging markets and risk off selling. South Africa tends to be bear the brunt of a lot of EM risk off selling in the global markets. We have a sophisticated and liquid currency market, so our currency often gets hit the hardest. And of course, our South African Reserve Bank coming in and cutting rates, the most aggressive rate cutting we've seen in South Africa in a very long time, where some of the previous rate cuts were looking at 25 basis points and so forth. So the Reserve Bank stepping into action, the government certainly stepping into action, but the impact was still really significant in our local assets. So the idea is that this is the big picture, this is what's happening. And then we want to have a dive into each of our funds, our high equity fund and our low equity fund, to understand the impact. We'll start with our wealth accumulation fund. This is a high equity fund. The intention is to, within the constraints of Regulation 28, to maximize wealth creation for clients. So it's not surprising that this fund has sold off quite significantly over the quarter. Total return down 16%. The major contributor to the negative total return being local equities, which we have a structural and a strategic weight of 50%. The performance of the asset class itself was down around 25%, and the contribution to the negative 16% fund return was about 12.8%. So even though only half, it amounts to only half of the fund's weight, its contribution to negative return was significantly more like 75%, which we should expect from risk assets. And another massive sell-off from the property market, this on the back of a lot of concerns around the lockdown and how landlords will be treating the lockdown in terms of rental collections. And notwithstanding this, there've been a lot of headwinds in the local property market over the last 12 to 24 months. So, property market over the last quarter has taken a lot of pain. Fortunately, though, in terms of our strategy, we look at diversifying foreign bonds being the largest contributor to return. So even though they are a relatively small weight in the portfolio, only making up 2.5%, their return contribution was significant. 80 basis points of return, positive return relative to the very small weight is significant. It's fair to say that of the 31.8 odd percent of return that we got out of our foreign bonds, a large percentage of that came from rand weakness. So around 25% of that return came from rand weakness. But nonetheless, it's there to provide some downside protection in these kind of environments, and that's its objective in the fund, and it seems to have delivered on that. So pleasing to note. And another few kind of mentions is that although global equities did sell off, we've got a global allocation to an equity type strategy where the sell-off was around 22%, but of course the corresponding rand sell-off was quite equivalent. So over the quarter, we see global equities sitting flat. So a lot of protection, or the fund was buffered in many respects by rand weakness in its offshore allocations, which make up 27.5% of the fund. So, a relatively significant percentage of the fund. The other asset classes of smaller weights, bonds, which are unlikely suspects in terms of sell-offs, did have negative returns. But of course, we've seen interest rates, the interest rate environment and the sensitivity to interest rates being something that's noteworthy. So, in total, wealth accumulation fund, reasonable, a large sell-off, not something that we're pleased about, but, we can see some of the benefits of holding a diversified portfolio as opposed to, let's say, for example, just holding an equity portfolio where you would have hurt and seen a 25% drawdown in your total portfolio. Moving on to the low equity fund. The low equity fund's intention is to provide growth, inflation protection, to provide reasonable levels of income, and then of course some capital downside protection. So relative to the wealth accumulation fund on the high equity side, it had some downside protection, but nonetheless, quite a large sell-off in this fund. Again, equities, although being SA equities, although being a small percentage of the fund, 27.5%, contributed to 50 odd percent of the downside return. That coupled with property, we've almost got all of our or local property, almost all of our downside has come from those two asset classes, which only make up 35% of the fund. So it's fair to say that the risk or the growth assets in this fund have contributed, I guess, disproportionately to the downside sell-off. But then again, on the other side, we see foreign bonds doing their thing, even though they're sitting at 2.5% in terms of positive contributions. And then some of the asset classes which are intended to provide downside protection in absolute terms, like short duration credit and cash, really have done their job. And that's a meaningful weight of 27.5% in the fund. So, the downside protection we got from the cash bucket and the short-term credit bucket have been very, very worthwhile allocations in the fund. It's also worth noting that some concerns around the credit market with rating downgrades and so forth, notwithstanding some of the environments or the current environment, it's worth noting that fund has, or that part of the portfolio has very low levels of duration. So in other words, it has lower interest rate sensitivity, and it invests into a diversified basket of credit. So we certainly don't expect any credit events in that part of the portfolio. It's intended to provide A, income, but B, downside protection, and that's what it's done. Same story goes for the rand dollar environment in terms of the offshore allocations. Even though offshore equities sold off 22.5 odd percent because of the rand weakness, we have actually been relatively stable there. So on the whole, it's been a really tough quarter for the funds, but we can see the benefit of holding a diversified portfolio in terms of how some of these asset classes contribute to the returns. The lingering question is our equity buckets. Is it a worthwhile allocation if it's exposing us to so much downside risk. The first point is that our equity bucket looks a little bit different to what we would call what's now the industry standard equity portfolio. If we look at a benchmark, which is the Swix Aussie Capped, we actually have in each of our different portfolios, different equity buckets. So in the wealth accumulation portfolio, we've got 50% in a multi-factor strategy and 50% in a vanilla beta top 50 strategy. So have those bets we've taken, which I guess you could say are off benchmark or off typical benchmark, been rewarded? And yes, they have. I mean, I wouldn't say it's significant, but the Swix All Share Capped Index was down 27.12% over the last quarter. Our equity carve out in the wealth accumulation was down 25.6%. So slightly more diversified. We've got different return drivers through the factors, and we've got the capping rule in our beta, which is the top 50. So it helped on some downside protection. But we can actually see that these portfolios behave quite differently to the Swix All Share Capped, which let's call it the de facto benchmark. In the low equity fund, we use a dividend strategy as half of our equity bucket. This is to align the goal of generation of income, and it's a quality income strategy. So we actually saw more downside protection in that, which is exactly in line with what we would hope, being a low equity fund, being a fund where clients would be more sensitive to downside protection. So have our equity choices been rewarded? Yes, they have. We've provided in excess of what the Swix All Share Capped would have done, but notwithstanding that, it's been a lot of pain we've taken. So we just wanted to touch on why we have equity in these portfolios and why we have such, I guess, significant strategic weights to equity. If we look at the total asset class risk reward trade-off, it's fair to say that equity, global and local, is one of the most rewarded asset classes, or is the most rewarded asset class in terms of the ability to generate returns. So in terms of the wealth accumulation goal, or in terms of inflation protection, relative to SA bonds, SA cash, global equities, etc. Equities is really an important building block in our portfolios. And this is really what justifies our exposure. And we wanted just to round off on this slide to say, keeping the goal in mind, if we look at equities versus bonds, perhaps the question is why we have more equities than bonds in say the wealth accumulation goal and in the stable income goal. It's for one of the primary goals in wealth accumulation. Of course, we want to maximize wealth creation. So achieving a CPI plus 5 return target is what's important to us. We can see that within the equity goal, over 100 odd year period from 1901 to 2019, the probability that equities maintain CPI plus 5 or help us achieve the CPI plus 5 goal is around, we'll achieve it on a 7-year rolling period around 65% of the time. If we're just invested in bonds, we'll only achieve it around 29% of the time. So, equities and that wealth accumulation goal, extremely important. In terms of stable income, we have a healthy allocation to equities, local equities at 27.5%. And again, the overarching return hurdle there is CPI plus 3. And we can see that even in the CPI plus 3 context, equities have a much higher probability of achieving CPI plus 3 over rolling 7-year periods than bonds do. So 75% of the time, equities achieve CPI plus 3, and only 36% out of the time, bonds have achieved CPI. Big equity sell-offs and these allocations to equity in our multi-asset funds. We know that equity is an important strategic asset allocation over the long term in order to keep the goal front and center in terms of achieving wealth accumulation, and then in the stable income goal in terms of maintaining our purchasing power in retirement. So thank you very much. This is our first quarterly update. So please send any suggestions. If you want more detail, please drop us a line, drop either Michelle or myself an email. Our details are at the end. Really, we wanted to say our approach to solving for investment problems is an evidence-based one. We look at using a strategic asset allocation. We look at diversifying. The global bonds is a great example of an asset class that's there to diversify, and it's provided some diversification benefits in recent history, and that all of this is sitting in a low cost environment. The uncontrollables: how quickly will the economy recover post-COVID? Are the stimulus packages the global governments are putting out, are they going to be effective? These are all unknown elements. So we look at controlling the controllables through a systematic evidence-based framework, and trying to dial down the noise and keep the uncontrollables, the speculation at a minimum. So thank you very much for your time. I hope you enjoyed this first quarterly update. Also, we'll be sending it out with our monthly newsletter, the Core Scores. So please feel free to drop Michelle her emails down at the bottom there, or myself an email, and we'll include you on that monthly distribution list, where we'll send out not just this quarterly update, but a whole lot of interesting information and facts.